So thanks a lot, everyone, for joining this session. This is our second session after the one that we did in June, right before the election results. And at that point of time, we had talked about how the market is approaching a new high, so we need to sort of protect our portfolio. And hence, we had discussed three ideas at that point of time: gold bees, silver bees, and Hang Seng bees, right? So we were looking at precious metals and we were looking at China as an additional geography in our portfolio because China had really bottomed out. And over the last 2 weeks, if you see, Hang Seng Bees has significantly gone up. There's a lot of money that is being pulled out of India and put into China, right? So that was the last update. And from there on, we are here, 13th October, discussing, uh, you know, the next move and our current, sort of thought process on what we are thinking, how we are thinking. And the idea was also to cover some of our non-performing bets in detail, so that you have an understanding of what we are thinking, from where we are getting that conviction to hold these stocks, and why we believe that these stocks will make money. Right. So from that point of view, let's quickly march ahead. Uh, just quickly, I want to cover up performance for the small cases. Your individual portfolios returns might be different, depending upon at what point of time you've put in the money and how long you've been invested with us. But both our Technofunda portfolio and VC investors portfolio, Technofunda is where we do active churning, we rotate sectors. Our 2-year performance is close to 55%, and our VC investors portfolio, where we buy some really, really long-term bets and keep averaging them, use every correction as an opportunity to average them. So those are the bets where we've done close to about 52.48% return over the last 2 years. So very similar performance for both the small cases. Now let's get into what we are currently seeing, right, in terms of the economic and geopolitical situation globally and what is happening in India. So geopolitically, you can see that there are two ongoing conflicts right now. One is Russia-Ukraine war, which of course the market has discounted and moved on a long time ago. Whereas this Middle East conflict is something that just keeps escalating. And with these fresh tensions between Iran and Israel, it looks like the matter can get worse. So from that point of view, I think the Middle East situation is something which might still come as a surprise to the market, and there could be a negative pressure because of that situation. What it might lead to is that some of these, FIs pulling money out of India and going back to their safe haven, which is US, right? So that could be something that might get triggered if the Middle East conflict gets escalated, right? And if it goes into a war where Israel is directly fighting with Iran, as opposed to its different branches, right? The second thing is that the US economy and the potential for the US economy to go into a recession is sort of becoming more and more clearer, right? So if you look at the data, of course, inflation is something which has come under control. So I think in the August data, it was somewhere close to 2.7%. But on the other hand, the unemployment numbers are going up. The other problem is that the growth rate is coming down. So, for example, the FY24 growth rate was close to about 2.7%. And going forward, it seems like that number is also going to come down. So the economy is slowing for sure. Unemployment is becoming a problem for sure. And it has so happened that whenever Fed has cut interest rates significantly, that has followed by a recession. So just statistically speaking, whenever such cuts have happened in the market, they've been because US is going into a recession, right? So in that sense, the Fed is slightly a lagging indicator because the Fed, what it does is it keeps cutting rates. If they believe that there is no recovery, there's no strength in the economy, then you might see more rate cuts coming, which is a sign of a recession and not of a strong economy, right? So you should look at the rate cuts in that sense as well, because rate cuts signify that there's something problematic and hence you need a rate cut. Than believing that rate cuts might make capital cheaper and there'll be more liquidity and hence the markets will go up. So rate cuts actually lead to stock market crashes, and this has been the case every time in the past, whenever Fed has done such rate cuts. So be very cautious. I think we are looking at a potential recession in US. Now we don't know about the time. It could come in the next 3 months, 6 months, or maybe 12 months. We don't know. Maybe early next year by March, April. But there is a very high probability of US going into a recession, at least in our opinion, right? The third thing is that over the last 4 years, if you've seen, especially Nifty 500 has done excellently well in terms of corporate revenue growth and corporate earnings growth, right? And that is starting to now slow down because obviously the base is quite high. The second problem is that there is declining demand. There is a lot of commodity pressure because of these wars and geopolitical tensions. And there was quite a good lending from BFSI also, which is sort of as you can see, the growth in lending has sort of gone down significantly. We are seeing more and less money being allocated to corporates. More of the capital is being driven to the retail segment, right? So that is obviously that we've seen. The only good thing as far as this season is concerned is that monsoon India has been fairly good. We've had a good monsoon, and hence recovery in rural consumption is something which is going to be an important theme. In fact, there was this report by Motilal Oswal as well, which has pointed that Nifty earnings will grow only 2% year on year. So that's not a great growth given that a lot of these companies are at excessively high valuations. The P ratios are anywhere from 60, 70, 80, 100 plus as well. So if these companies don't deliver on the quarterly performance, then you might see them derate a lot, right? There's liquidity pressure also because money is being pulled out of India and diverted to China or to some other emerging economies maybe, or even going back to US. So liquidity is going to be a concern. Now, so with that being said, so we are mostly looking at a negative environment given the geopolitical tension, given the US recession. There is, however, a small silver lining in terms of rural consumption, pickup in rural consumption, right? And that is sort of the theme, the situation right now in terms of economic and political situation. So in that context, now let's look at Nifty 50 and Nifty 500 broadly. Nifty 50 top 50 companies, Nifty 500 top 500 companies. Now, if you look at the last 1 year, Nifty 500 has given 35% return and Nifty 50 has given 25-26% return. So, Nifty 500 has obviously overperformed Nifty 50 by a huge margin, almost 10 percentage points, right? In terms of, and that's been the case because your top 500 companies, sorry, the top 450 companies, leaving apart the first 50, they have grown their corporate earnings at a much faster pace than the top 50. And hence, it made complete sense for Nifty 500 to outperform Nifty 50. In terms of the Nifty PE price to earnings chart, if you look at Nifty 50 generally peaks around 28 to 30 times price to earnings. Currently, it is at 23, 24. So we have some margin there before we can say that the market is frothy, right? So there is some scope. Similarly, for Nifty 500, if you see, the P ratio peaks around 30 to 32. Currently, we are at 26, 27. So again, here also we are seeing some room, right? So a couple of things that we can summarize after looking at these two charts is that there is some potential both in Nifty 50 and Nifty 500 before we can actually say that the markets are frothy, right? Does not mean we will get there, but we can't definitely say for sure that the valuations are excessively high. Like these are, valuations after which the market should definitely crash, right? So that's not, we are not looking at a crash or a bubble type scenario. We are looking at, earnings growth driving stock markets and price to earnings. However, those earnings are now sort of expected to get softened, right? So it's not going to grow at that pace which it was growing for the last 3-4 years. And because of which there might be some rationalization in the price to earnings ratios also, right? So now let's look at, so in terms of, Nifty 50 and Nifty 500, given that, the geopolitical situation and the economic situation is not that great, It's good, but it's not that great. We expect a softening of numbers. And in this context, I want to sort of talk about our own strategy where we are looking to rebalance our portfolio and book our profits in the Nifty 500 segment, so to say, companies that have done really well over the last 2, 3 years, and shift some of our capital, of course, to Nifty 50 companies. So we are looking at a possible rebalance where we are diverting some capital, booking profits, diverting capital from Nifty 500 to Nifty 50. Now, why that is the case? Because Nifty 50 performs better during market slowdowns, right? And if there's an economic recession in US and possibly an economic slowdown in India, because if you look at the GST collections also for the month of September, they have been fairly low versus, relatively speaking. So we are seeing some softening, and Nifty 50 generally sort of corrects less in a broader market correction. Nifty 50 companies today are trading at a better price to book and price to earnings ratio. So they're fairly valued. They are not at all excessively valued. They are in fact valued on the lower end. There's a lot of room for earnings and book value to get rated over the next 1 or 2 years, right? And financial services contributes 30% of Nifty 50. So one third of Nifty 50 is all BFSI sector, and banking and financial services really has not done that well. In fact, it has underperformed the broader market even during the last 2, 3 years, right? So for those reasons, I believe that Nifty 50, and because markets being cyclical, Nifty 50 at some point of time will start performing, and Nifty 500 will sort of start softening or cooling down, in my view, over the next 1 to 2 years, right? And we are rebalanced accordingly. Now, the same thing can be seen technically also. So let me quickly go and open trading view. So if I were to look at Nifty 50, and we are going to look at the relative strength indicator here, right? So this is my Nifty 50 index, and I am going to use relative strength indicator against Nifty 500. So Nifty 500 will be the benchmark. Basically, we'll be comparing Nifty 50 against Nifty 500. So, and let me go to the monthly chart. So if you look at, it's an interesting chart. What it means is that this is the zero line, this is your zero line. So whenever the blue line goes above the zero line, Nifty 50 has done well versus Nifty 500. As you can see here, CNX Nifty 500 is the benchmark, right? So, and whenever the blue line comes below the zero, it means Nifty 500 has done better than Nifty 50. So if you look at Indian markets from 2003 onwards, let's just say, then there have been broadly two phases, and we are in the third phase right now, where Nifty 500 has done much better than Nifty 50. So as you can see, from 2004 to 2008, that was a 4 year phase where Nifty 500 outperformed Nifty 50. And that was also the time when we saw a very good bull run in India markets. After that, we had the 2008 financial crisis, and post the crisis, we saw Nifty 50 doing much better than Nifty 500. So the top 50 companies generally perform better in an economic slowdown. They have much more strength in terms of their balance sheet, their P&L, their ability to absorb losses. And so typically the capital moves from Nifty 500 to Nifty 50 in situations where we are going through a financially difficult economic and geopolitical situation. Then what happens is from 2015 to 2019 onwards, we again see a situation where again, of course, Indian market, gives another 4 year rally, very good rally. And again, Nifty 500 beats Nifty 50 by a huge margin. And post that, we had, of course, the COVID crisis. Now, see, just after the COVID crisis, we, for a period of, 2, 3 years, we see Nifty 50 outperforming Nifty 500 again. Again, I'm trying to prove this point that after every economic and financial stress situation, Nifty 50 starts to do well versus the Nifty 500. And since 2022, after COVID, basically, we saw Nifty 500 start doing well, right? So all these smaller and mid-cap companies, they started doing well in terms of, their earnings, their growth, of course, supported by China Plus One and some of these things where, Indian companies were able to export more globally, right? So we saw that phase, and Nifty 500 again did well, better than Nifty 50 for the third time, right? So you had 2004 to 2008, 2015 to 2019, and then, 2022 to 2024. And I think by the time we are into 2025, 2026, this is now going to give a U-turn where now Nifty 50 will start doing better than Nifty 500. So that is also, going on into the consideration in terms of the geopolitical and the, economic situation that we are getting into, where we certainly believe that it makes sense to rebalance our portfolio and get into more of these top 20, top 50 stocks, which do generally better in a difficult economic situation, right? So I hope you get this point well. And that is one of the reasons why we are also looking to rebalance our portfolio. Now, just I just want to quickly, given this backdrop, given how we're looking at Nifty 50, given how we're looking at Nifty 500, what are we doing in terms of our portfolio, right? And we've done a lot of rebalancing recently. We've booked profits. We believe that the markets, are at all-time high. We believe that there's a possible recession in US. Now, quickly, I want to do one more thing, is I want to show you the S&P 500 chart, right? I did this last time, but I want to give you another update on it. So let's go to S&P 500. And we are on the monthly. Yeah. See, this is a really long time frame. We are looking at S&P all the way from 1926 up until 2024. This is the Great Depression. Now, post the Great Depression, S&P took almost 30 years to recover. Then we had the inflation situation in 1970. Basically, inflation, rose up in US, and then, S&P underperformed for a very long period of time. And it was not back until 1982 that, it started performing again. Now, from here, the rally continued, and we had a sort of bubble in 2000 to 2000.com bubble. That peak and the 2008, 2007 peak, financial crisis peak, sort of, are at the same level. Then the market recovered in 2013. So from 2000 to 2013, S&P again was underperforming. Now we are very close to this channel. Now this channel is important because what I have done is I have created a channel which touches all these high points. It touches the peak of 1929, it touches the peak of dot-com bubble, and then now it is sort of trying to touch this, channel, the peak of the channel again. So, and post this, I believe that whenever this has happened, the S&P has underperformed for a very long period of time, 5 years, 6 years, 10 years maybe. But I definitely look at a situation where, after it touches this level and, we're looking at anything between 6,000 to 6,500 S&P level. Post this, I do not expect S&P to sort of create a new high. That's where I'm looking at S&P, and this has to happen because US will get into a longer term economic issue because it will get into a recession. At least that is our thesis, right? So I don't see upside in terms of S&P. And if US markets correct, Indian markets will also correct. If not, at least 15-20% correction is possible. We have already seen a 6% correction. But I do expect that in the next 3-4 months, whenever Indian markets will correct, at least 20%, after which Indian markets will be a very good opportunity, right? Because the valuations will come down, right, and all of that. And so I think we will end up finding very good opportunities there. So that is what we are sort of seeing right now. Now, in this context, what we are doing is we are investing in large cap banks. There are broadly 6 buckets where we are deploying right now. We are investing in large cap banks and some turnaround situations like Sammaan Capital, Yes Bank. These are turnaround banks which have already gone through a lot of restructuring in the last 4-5 years, right? And then we are investing in chemical because chemical has not performed since 2021, September 2021 peak. Chemical has not performed. In fact, chemical has corrected by significant 25-30%. All the chemical stocks have gone through a correction, either a time correction or a price correction, right? Then the third bucket is obviously gold and silver, which is precious metals. We discussed this last time also, but this is a hedge against, of course, a recession in US. Fourth bucket is pharma. Pharma continues to do well. It's a 2015 breakout sort of. We have three positions here: Natco, Dr. Reddy's, and Gland Pharma. We are bullish on all three, and we will discuss them subsequently. China and via Hang Seng is good to have a third economy in your portfolio as a diversification because look, India and US are very connected. Anything that happens in US affects India, but China supposedly is a very different cycle because as India and US are peaking, China is actually bottoming out, and we believe from here on China will do well, whereas India and US might sort of correct. US of course will go into a long-term recession. India will correct slightly and then recover. We are an economy that continues to grow at least 7%, CAGR. So for those reasons, our stock markets will do well. And the sixth bucket is FMCG because purely because of the rural consumption and the good monsoons that we saw. Because of that, there is consumption growth in consumption from the rural economy. So if you look at what happened just post COVID, Indian markets. In fact, globally, we saw a lot of luxury cars being sold, right? So you had Audi, BMW, Mercedes declaring best ever numbers in the Indian market and globally because there was a lot of demand for these luxury cars. However, there were not too many two-wheeler sales, right? So Hero MotoCorp and Bajaj Auto were underperforming for a very long period of time, while you saw Tata Motors and Mahindra do well, right? Whereas now we're starting to see, both of these two companies also declare good numbers, which means that the COVID hit and COVID badly hit rural consumption because, of course, these people have no insurance and they had to pay for their medical expenses from their own pocket. So it did hit them badly. The rural consumption sort of story went for a toss for a good 1.5 to 2.5 2 years because it took some time for that to recover. But I think with the monsoons doing well every year, there is recovery in terms of consumption, and so we've sort of gone ahead and taken some FMCG bets as well, right? And broadly in terms of strategy, if you look at, we were for the last 2 3 years chasing momentum, right? So we are going after stocks that were purely in momentum, but these momentum stocks over the last 2 3 years have become expensive. Now, if there is any underperformance in terms of quarterly results, we may see a significant drop in the share price, and which is where we've taken that call that it makes sense to now sort of book profits and move to value segments, value as in valuation. So wherever the valuation is very low or the stock is cheap, we are more than happy to sort of increase the position there rather than keep increasing our bets in the momentum stocks because whenever the market gets a surprise, either because of US recession or because of escalating geopolitical tensions, market can go through a significant correction, and we don't want to be sort of stuck in those stocks at that high valuation, right? It's actually very painful when you are sort of stuck in something for a very long period of time and not being able to sort of get your capital, not being able to sort of rebalance your portfolio. It is a painful process. So we proactively have decided to move to value, look for areas where the valuation is very reasonable, look for areas where there has been underperformance for the last 2 3 years, so that we whenever the market turns upward, we are sort of benefiting from that up move. And of course, as you can see right now, there's a lot of capital that is being rotated. So sectors where have underperformed will of course get higher allocation from now onwards. Sectors that have already performed, you will see that the allocation is coming down. In fact, if you already noticed, all the defense bets are already 25 30% down from their peaks, right? So there is correction happening. There is liquidity that is going out of Indian markets, and hence for us, small and mid caps, we are sellers there. We are mostly moving to large cap stocks, large cap banks, large cap pharma, large cap chemical, Hang Seng, FMCG, precious metals. So these are the bets that you are taking right now. So hope from strategy point of view, you are sort of aligned. Now let's look at the bets which have not done well, and some of you have sort of raised concerns that these stocks are not moving, right? So what you will see over the next 3 4 slides is a lot of turnaround situations. So wherever the stocks have not done well or there is no momentum in the stocks is because we picked them because there is no momentum in the stocks. Second thing is that these stocks will move slowly. They are consolidating right now, and most of these are turnaround situations. So what happens in turnaround situations is that as you see the quarterly results come out, you then start to see the stocks moving up, right? And it takes some time for the market to realize that these are turnaround situations and that these companies are doing well. And if you ask anybody right now that, Yes Bank is a good investment, he is probably thinking of what happened to Yes Bank 5 years ago, and he'll probably say, no, Yes Bank though is a distressed bank, right? It's not a bank that you would want to invest. It's a very risky investment because Yes Bank is a distressed bank. That is the general opinion of that people have about Yes Bank. But they have not seen the numbers. They're not seeing the quality performance. They are not seeing the quarterly results. They are not seeing that the NPAs have come down and the bank has gone through significant rounds of restructuring. So what happens is that, initially only few people appreciate the opportunity. And so what happened with Suzlon, for example? Suzlon, we started buying at 15, 16. And when the price had reached 35 rupees, that is when you had the first report on Suzlon. I don't know which brokerage had published, but when the price was already 35 rupees, then came a report on Suzlon saying that, Suzlon is a good buy, right? So generally what happens is that, we are early into these trades before it becomes a mass trade, right? Before the normal market and everybody in the market start to realize कि नहीं नहीं Suzlon बहुत बढ़िया share है, right? So in that sense, we are slightly early. We are trying to, we are already sort of trying to make our positions here, and these are not well-known trades in the market right now. So, and as these opportunities, as these turnaround companies declare their quarterly results, and the general market then starts to understand कि नहीं नहीं बढ़िया company है, things have turned around. That is when you will see that the stock price starts, the company starts to re-rate and the stock price starts to go up. So it will take some time. I will sort of tell you our thesis again. So SW Solar is a renewable energy. It's an EPC company, right? So what it does, it takes projects, executes them, passes on to the owner, and then move to the next project, right? So they are merely building and passing, right? So their capital is not involved. And that's what we've done. We've done with solar. For example, KPI Green is also a EPC company. We've made good money there, right? In the solar space, we're looking at EPC companies only. Excuse me, because EPC companies don't have to put a lot of capex. The returns are higher. You can rotate your working capital and execute the project and move on, right? So SW Solar, I'll tell you quickly, they were doing something wrong. For a good 3 years, they were loss making and what happened during COVID was that they got into fixed price contracts. So they would buy the, solar modules from, let's say, Chinese companies, and they would execute those projects and pass it on to the owner. But what happened during COVID was that all these solar modules became very, very expensive. And because they were in fixed contract with their clients, they could not pass the excess cost of buying the raw material to their clients, and so they had to take it on themselves, right? So it was much more expensive than what they had calculated, and hence in executing those projects they had to incur great losses. So that was one. Second thing is that they were focusing a lot on international markets where the cost of generally operating is very high, right? The margins are low, cost of operating is high. They had, this issue during COVID where the module prices went up significantly. So that again was an issue. Over the last, quickly, let me just take you through the story also, because you should see the numbers to appreciate the story. So Sterling and Wilson, over the last, this is the balance sheet. If you look at, they have reduced their borrowings from 2,000 odd crores, and they have brought it down to 516 odd crores, right? The working capital and out of this 516 odd crores, half of it is working capital and half of it is long-term borrowing. This reduction in debt has been helped by Reliance, of course. So Reliance, as a promoter, Reliance New Energy Limited, this is the new energy business of Reliance, and they acquired this business in March 2022. Shapoorji Pallonji, which is the other promoter on the board, they have reduced their stake to 12.5%, and most recently they sold another 7%, right? Because of which we saw a significant correction in the stock price. Now, the reason that these guys have given for the sale of shares, for the sale of Sterling and Wilson shares, is that they wanted to use that capital for their data center business. So there is nothing wrong with Sterling and Wilson. It is purely because of their own requirements in terms of deploying capital to data center business, which is why they have sold these shares. It's not that Sterling and Wilson itself is going through some problem or there's something wrong with the company, right? Reliance continues to stay as a major promoter, and if you know, Reliance has huge plans in the solar and the renewable energy space. They have in fact bought a company which was earlier Chinese controlled, is now is now Reliance controlled. That company is directly into manufacturing of PV modules, and now they have also acquired an EPC company. So Reliance is trying to acquire businesses across the value chain. So because they have amazing, tremendous lot of capex planned in this space over the next 8 to 10 years. I read somewhere that they want to do more than 85,000 crores of spending is just in just renewable energy space, right? So that is going to happen, and SW Solar will be a huge, huge beneficiary of that. If you know, they are going to build gigawatts of solar capacity in Jamnagar, right? So that is something in the works, and I think very soon you will see orders coming to SW Solar from Reliance for executing that particular plant in Jamnagar, right? So as we can see, and look, there for the last 3 quarters, they've been profitable, 1.4 crores, 4.8 crores, 8.57 crores. So they are delivering profits quarter on quarter, whereas for the last 3 years, in fact, for the last 4 years, they were loss making. So 2021, 2022, 2023 and 2024, all 4 years they were loss making. Now they are again starting to become profitable. So it's a turnaround situation. New promoter, new business model. They are no more doing fixed contracts. All contracts are passed through. So they are not going to bear the consequences of a raw material increase because of whatever, because of geopolitical tensions, because of COVID, because of whatever may happen. Everything is just passed through right now. So because of those reasons, I believe that this company is, and of course, it's in the renewable space. So renewable is growing. India, of course, in terms of strategy, in terms of markets, also they have started focusing on Indian markets more because Indian markets are profitable. Indian markets, there is high ROE, ROC on these projects. So it makes sense to move to India, and they have stopped sort of expanding their order book on the international sector. Right, so that's the story here. In terms of technicals, if you look at, so fundamentally, we are very strong. We are, our conviction is very high. Technicals also, we believe that the stock is taking the right support levels. We've seen some correction, but the stock is taking support. For example, on the monthly chart, the price came down all the way up to 500 rupees a share, and it has recovered now to 557. This blue line, which is the middle of the channel, it's a good support level, and it's a good thing to see the stock recover back to those levels, towards the end of last week. So as you can see, the closing is above the blue line, which is very heartening, at least for me. It took support here and then recovered. So I believe this channel that you see here, the stock is supposed to sort of consolidate in this channel. And there's also an all-time high breakouts type of situation. So as you can see, the 2019 price, we are very close to those levels. So it's all-time high. So fundamentally there's a turnaround. Technically, there's an all-time high breakout. Our kind of trades that we love to do. So we believe there's a huge opportunity in SW. Now let's look at Sammaan Capital. Sammaan Capital is the erstwhile Indiabulls housing finance business. Now, in terms of just housing finance, let me tell you that housing finance is a very good growth industry as of today, because you've seen that over the last 3 years, real estate industry has done well. Now, it generally so happens that real estate industry leads and the housing finance industry lags. So there's a 2-3 year lead lag sort of thing, because first you make homes and then you sell homes, and all these homes are, definitely end up being taken on loan. So you've seen that over the last 2-3 years, real estate industry has done well, and so of course housing has to do well because of course people are buying more homes, they are taking more loan, so that industry has to follow. So across, if you see Awas ho gaya, Aadhar housing ho gaya, Aptus ho gaya, Home First ho gaya, you recently saw Bajaj Housing Finance ka IPO, Aadhar Housing Finance IPO. All of these have sort of done tremendously well. All these stocks have done tremendously well. So Sammaan Capital is in the same housing finance business. Now, in 2018-19, when DHFL went down, Sammaan, which is Indiabulls Housing Finance, also went down during the same time. The promoters has since, which is Samir Gehlot, he has exited the business, right? And this is now owned by Blackstone, and it has gone through multiple rounds of restructuring. So if you look at Sammaan, right now, in terms of price to book, it is only 0.56 times. So, much, much cheaper. I don't think the broader market has understood this opportunity right now. And if you look at the balance sheet, they have significantly deleveraged themselves. In terms of their business model, they were earlier housing finance company. Now they are an NBFC. So they have changed their business model also, right? If you look at 2018, 2019, their balance sheet size was 1,11,000 crores. On a 14,000 crore, on a 14,500 crore odd equity, you had 1,11,000 crores of borrowings, which is 5 to 6 times of leverage. Now that has significantly reduced, as you can see today. We are only at close to 58, 48, 50,000 crores of loan book on a 20,000 crore equity base. So the leverage has consistently, like, considerably reduced. They have changed their business model to co-lending, where they're only lending 20% of the loans. So they are making a lot in terms of originating fees and all that. And then they are deploying only 20% from their book. Rest 80% is coming from their banking partners like banks and NBFCs, right? So because of that, I believe that it's a very good model of co-lending, high ROA model. In fact, the company is planning to reach 3% ROA by 2017. And what they have done simultaneously while they are starting to grow their retail book is that they have cut down their wholesale book, and that was the main source of NPAs, right? So they have paid, sold a lot of their assets, returned the money. As you can see, they have reduced the loan book. So they have done all of that for the last 5, 6 years. This has been in sort of in the working over the last 5, 6 years. And I think it's an excellent trade because it trades at 0.5, 0.6 times price to book. Very good, valuation. The book is almost new now. We are looking at, a retail business growing fast, wholesale book, reducing. All of that is good. Now, if we look at technically, the stock came down from 1257 all the way up to 81 rupees a share, and this happened in 2020, as you can see, the lowest. Ever since then, it's been sort of going into this channel. It has formed a base formation. So this is the base. 81 rupees is the base, and then it gave a breakout. Breakout के बाद फिर there was this crossover where the 20 moving average goes above the 50 moving average, and that's when we started taking interest. Now we've bought all through. Our buying price is slightly high. Now, if you look at what is happening right now, is that this is the triangle where it is consolidating. So I just zoom in slightly. So it is not going to come below 147 rupees a share, and it's been consolidating in this zone. It goes up, comes down, goes up, comes down, and at some point of time here it will give a breakout, which I think will be triggered by very good quarterly results. And which is what I'm trying to point, that with turnaround situations, it takes time. The quarterly results come, and then the market realizes कि नहीं अब situation improve हो गया है, and then the stock starts to re-rate. So I definitely see a lot of re-rating that needs to happen in the entire housing finance sector, by the way. And let me cover this point also because it's very important. I believe that the entire housing finance business is sort of getting re-rated now. And I'll talk about a couple of housing finance business. I'll show you that over the last few years. Now, this is the 2016, 2019 phase, which is when you had DHFL, you had ILFS crisis and all of that. So, these housing finance companies were growing very fast then, and then they got P-rated. So one of the best housing finance companies is Canfin. It came down to almost 2.3 times price to book. The average is 2.3, came down to almost 2. And then, it's been in this level since then. Price to book of 7, 8 is a very historically, this sort of is improving. And I think if you look at Canfin also, it has also given an all-time breakout. Now let's look at some of the other housing finance, for example, Repco Home Finance. Again, same chart where, price to book over the last few years. For example, this again 20 has, this was trading at price to book of 5 times, got derated, came down to 0.4 times price to book, and now sort of slowly and steadily starting to get to 1. So current price to book is close to 1.1. So that is the case with every other housing finance company. Let me talk about a few, for example, PNB Housing Finance, price to book ratio over the last 10 years. Again, you can see here 2016, 27 price to book 5.6 comes down to 0.5. Currently, price to book is around 1.72. So it has re-rated 0.5 to 1.7, and that has happened over the last 4 or 5 years, which is why I believe all of these housing finance companies are candidates for re-rating. And as more and more growth comes in, the loan book is fast, loan book growth is fast, NPAs come down, and all of that, these housing finance companies will start to go up, and that is already starting to happen. So, couple of thesis pointers. First of all, the housing finance industry is doing well. Second, Samman has gone through major restructuring for the last 4 or 5 years. and the stock has given a breakout. It's a reversal breakout. We've bought. We are also buying. So, but we believe that it's a good sort of turnaround situation. The management looks very promising right now. I think the stock can easily get to 300, 350, that sort of range in terms of the target over the next 12 to 18 months, you can say. And similar is the situation with Yes Bank also. This is also a position which has not done well for us. And it's consolidating for the last 6 months. But again, same pattern you will see. Stock was trading at, I think, 400 plus. Yeah, stock was trading close to 400 rupees a share, came down all the way up to 9, 10 rupees, which is when, all these banks, SBI and ICICI and HDFC had to come and rescue. And over the last, couple of years, if you see 2021 all the way up to 2023, 24, the price has gone up. Of course, it will not go up every day. It will consolidate, go up, and that is how the stock moves. But, this was a good breakout for us. And after a very long period of time consolidation, 21 rupees का जो level था वो टूटा, and then it formed a new all-time high, and ever since it's been consolidating. But look, again, it's a consolidation channel, and unless we go through this phase, the stock will not give a breakout. It will not make a new high. So there's a breakout expected soon, but this will consolidate in this level only. I must tell you that it will not come down below 21 rupees a share. So Yes Bank cannot go below 21, and so the downside is very limited. We are not looking at a major fall from here because the bank and all of these turnaround situations have already gone through something very worse. And over the last 4 or 5 years, something they've only survived, and they've only grown. So I don't see a major de-rating to happen because they have not re-rated yet. It's not that these financial institutions are trading at excessive valuations, and hence a possible correction might reduce the price to book going forward, right? In fact, we're looking at a situation where the business is now normalized, whereas the valuation is not, because the broader market does not think of these as investing ideas. The broader market does not appreciate that these companies have gone through a major turnaround over the last 4 or 5 years. In fact, let me show you. So Yes Bank, again, for the last, every quarter is a better quarter, in terms of results. If you look at, they did 160 crores, 340, 467, 516 crores. So 516 crores, most recent quarter was the best quarter. And what they are saying is that they are looking to acquire a microfinance business to improve their margins. And they had a lot of capital, almost 44,000 crores of capital stuck with RBI, where they were making a yield of where they were making a yield of repo rate minus 2%, right? So on 44,000 crore, so that capital will come to them, they will start deploying, and the yield on that will of course start coming. So that is the next trigger for the stock to get re-rated, improving profit margins, and they are already sort of looking at buying microfinance institutions to increase their profit margin. So that also continues to be the case, and we are very, like I said, it will happen. It will happen quarter after quarter. Numbers will come, and then the stock will keep re-rating. I, for one, definitely think that there's a lot of potential. This stock can easily get to 50, 55 rupees a share. I don't think it will get to 400 rupees a share, but 50, 55 is definitely a possible target given the huge amount of dilution that has happened. The company has, in fact, I'll show you in the balance sheet, from 2019 onwards, they have done multiple rounds of, fundraising, both debt, both equity, in order to make the balance sheet stronger. And over this period of time, they have written off all their losses. For example, they in 2020, they written off 16,000 crores of NPA, then 3,400 crores of NPA. So, these 2 years were the most important restructuring years, right? And from then on, you will see the 736 crores the profits, say, 1285 crore profits, and then 1455 crore profits. So you're starting to see the profit numbers grow up. In fact, 2018, they did 4,000 crores of profit. So I, for one, definitely think that, 4,000 crores of profit is definitely achievable. And, the profit number will double from here, and hence the stock price will double from here. As simple as that. So that is the thought process with which we are staying invested in Yes Bank. Okay. So let me move on to Yes Bank we've discussed. Now let's look at Equinox. Equinox, of course, is another Indiabulls company. Indiabulls Real Estate is now called Equinox India. This also went down at the same time when Indiabulls house went down because of Sameer Gehlot. And ever since then, this business has also been restructuring. It has also gone through a turnaround. Blackstone was the initial supporter. Now we've seen interest from Embassy Group also. So Embassy Group, which is a huge, real estate group in Karnataka and Bangalore, and some South Indian cities, they have shown interest in acquiring Equinox. The matter is still under NCLT, but as we speak today, Embassy Group already holds 20% in Equinox. So they are sort of already trying to. So there's a new promoter. There is, and like I said, the industry tailwinds are very good because that real estate industry has done very well. I'll just go to the, you know, I'll go to the real estate bucket. So if you look at, all of these real estate companies, they've done very well. Let me talk about DLF. So DLF has sort of given a complete U curve because the last time the real estate industry did was almost a decade ago. So long time ago, and it has not even reached the previous peak. 2008 peak has still not been achieved. So I believe there's a lot more room for the real estate industry to do well from here onward as well. And it's a pure U curve. For a very long period of time, real estate companies made no money. They've started to make money. ये हो गया इसके बाद I think Shobha also very similar. Shobha again, has from 2024, 21 rupees to a share to 1700 rupees a share. Then, and this is again, like you see, it's an all-time high breakout. So 2007 was the previous all-time high, and now we had a breakout very recently in December 2023. And that's been the case with the entire real estate bucket. This is Prestige Estate for you, again, a major real estate player in Bangalore. They've gone from, 500 rupees a share to 1800 rupees a share over the last 2-3 years. So the entire real estate bucket has sort of re-rated, whereas Equinox India is still sort of lagging. And because it has been a restructuring story, it's sort of still lagging. I believe that, this also should start to get re-rated. Let this chart open up. But yeah, as you can see here, for Equinox also, for Indiabulls Indiabulls Real Estate also, the peak was 2007, December 2007. And since then, the stock has only corrected. We are looking at a possible breakout situation here, right? And so for us, this breakout is very important. So fundamentally, there's a new promoter, there's business restructuring, there's a lot of new existing projects, and huge land bank. And we did the maths together, all of that adds to anywhere between 20 to 25,000 crores. And so, Saman today trades at only 8,000 crores of market cap. Only 8,000, sorry, not Saman, Equinox. Equinox India today trades on only 8,000 crores of market cap. And our math says that it should be anywhere between 20 to 25. So there's huge re-rating potential. The stock is on the verge of giving a reversal breakout. So whenever that breakout happens, we will buy more. This is a very high conviction bet for us. Very little downside here, in our opinion, because the book value of the assets only is just a lot, right? So that's our thesis here, and the story is yet to pan out. Like the other real estate companies, how they've sort of already done a U-turn. Equinox has not even started, right? So from that point of view, I think there's a lot more potential. Let's look at the next bet, Paramount Communications. But before I get to that, let me talk about Gland Pharma and RBL Bank. So Gland Pharma, again, industry is doing very well. Pharma industry is doing very well. They specifically had, very internal to them. They had a few issues. For example, one of their clients in the US had to declare bankruptcy. And they did an acquisition. They acquired a company called Synexi, which is a loss-making company right now, and they're trying to turn it around. So, that is very specific to this company. Couple of products where they saw a lot of competition in US, so that led to reduction in margins. But this company has sort of guided for a 30 to 33% margin and a 15% revenue growth for the next year, which we believe is quite reasonable, quite good. From a technical point of so fundamentally for us, we sort of maintain our conviction. We did see some issues with the company in the last 1 or 2 quarters, but I think those are more transient, does not reflect the true nature of the business. And this is a large injectables player, right? So injectables is a very difficult business for a pharma company to get into. right? It's a fast growing area even in US. So I think from that point of view, this was very interesting. There was this huge correction after the IPO, and this was breakout, and we started buying after the breakout. The stock has been sort of in this channel over the last few months because of the transient issues that I mentioned, but we remain hopeful. I think over the long term, this has to re-rate back itself to 4,000 rupees a share. That's what our target is. So we'll continue to stay invested. We're not sort of panicking right now. We do see recovery in the stock, very soon. I think this quarterly result should lead to some sort of trigger and recovery in the price performance of the stock. Next is RBL Bank. Again, we've been holding this for a very long period of time. We started buying at what 40 rupees a share. This is again a restructuring story because it came down because there was this erstwhile promoter who had done some scams, and because of that, the price almost crashed from 700 rupees, came down to almost 100 and 80 rupees a share. And since then, the turnaround has been sort of happening. Uh, we had a breakout situation here at 140, 150. That's where we added. Now, again, it's been consolidating in this zone. In this zone, we believe that, this again is a re-rating opportunity because the stock only trades at, RBL Bank currently trades at I think less than one times price to book, 0.85 times price to book, which is, very reasonable valuation, no valuation to at least sell. And if you look at over the last, look at from June 2021, gross NPA 5%, net NPA 2% came down to, net NPA has come down to 0.74%, gross has come down to 2.6%, and, consistently it has come down. And that's when, the stock also has gone up. So we believe that there is a lot of re-rating potential here also, like Yes Bank, like Saman Capital. This financial institution also has to get re-rated over the next 12 to 18 months. We believe that the stock can easily go back to 500, 600, right? And, because I'm talking a lot of about a lot of restructuring stories, let me talk about one restructuring story which has panned out that way. One bank that actually saw its share price improve significantly. And if you remember Chanda Kochar time when there was some, corporate governance issue, and I think it was 2018 during this time when the price, sorry, ICICI Bank. Let's see. Let me see. So ICICI Bank during this time, 2018, was trading at 250 to 300 rupees a share. And if you really, go back and look at the price performance, you will realize that, it took good 5 years for the stock to become five times, or four times, sorry, four times, you know, because 2018 से लेकर 2020 तक तो कुछ return नहीं बना. It went up, came down during COVID, and then, started. So by the time it actually started going up, the 3 years had gone by. So what I'm only saying is that there are phases. For example, uh, just look at this phase where, the price went from 527 rupees a share to 387 rupees a share. So significant drop, but you have to go through these phases to sort of take advantage of these phases, right? And it's not going to happen overnight. It will take time. It will take time as the quarterly results come through and as the business really starts performing and the broader market starts understanding that it's a turnaround situation. That's when you will see these stocks get re-rated. And that's what has happened, right? So ICICI Bank, in terms of the price to book, over the last 5 years, has got re-rated from, it used to trade at price to book of 1.8 times and, is now trading at 3.5 times. So this is a really 4 or 5 year turnaround story. And similarly, we are looking at Saman, we're looking at S Bank, we're looking at RBL. All of these are supposed to be turnaround stories for us as well. Now let me come to Paramount and Premier. Premier I'm going to take last, but Paramount, again, a turnaround story. And what this company does is it manufactures cables, it manufactures power cables, telecom cables, railway cables, and these have been the buzzwords for the last 3 years, right? Power investments, telecom investments through 5G, railway investments and a lot of railway investments through Vande Bharat and all of these new trains that government has launched. So this is one of the sectors which has benefited significantly from this capex, mostly public capex that has happened over the last 3, 4 years, and not just this company, but HFCL and a lot of wire companies have made a lot of money, right? And Paramount is again one such play. It's a turnaround. Like a couple of years ago, they had to go through a restructuring. They've reduced their debt completely. So now a fresh company, good promoters. We are looking at a company which is looking to expand. They've recently raised money to put more capex. So everything is looking good, but the company has not re-rated yet, right? So if I look at HFCL, for example, HFCL currently trades at a price to earnings ratio of 53 times, whereas Paramount Communications still trades at a price to earnings of 25 times. So half of what its peers are trading. This re-rating has not happened yet. And in my view, that will take some time to happen. Technically, it is giving an all-time high breakout, which is why we started taking interest in this company. So let me show you the chart. This is Paramount Communications. Previous all-time high was 2006. Ever since it has corrected, went through multiple rounds of restructuring. From 2014 onwards, the stock price has sort of inched upwards. So as you can see, 2014, it's already been in the restructuring for a very long period of time. Stock price was 1 rupees. Today it is 87 rupees a share. And you can see here. So this was the all-time high breakout. It is currently in the consolidation phase, as you can see. The channel here, it is going up and down on this channel. It will go and it will give a breakout somewhere here. There is some time before we get a breakout. But whenever this breakout happens, it will try and go reach to its 230 to 40 target, right? So that's the reason why we continue to stay invested. Again, a high conviction bet for us. We are not looking to exit this. Now, the last bet that I want to cover, which sort of didn't do that well, is Premier Explosives. Premier Explosives is a defense company, right? And they manufacture explosives for Indian government and ISRO and the Indian missile program, right? So they are in a very sensitive sector, and only few companies get licensed to do this business. So it's almost like a huge entry barrier. No new players coming into this space. And generally, I believe that defense is going to be a focus area for a long period of time. And let me quickly explain you my thesis. My thesis here is that, for almost up until 1900, Europe was the major, global leader on this planet, followed by US. And that transition between after 1900, when US started becoming more and more prominent in terms of its economic position, in terms of its political, in terms of its military, in terms of its defense. That is when we had those two world wars, World War I and World War II, right? Now we are getting into a situation where China is becoming more and more sort of powerful. Between BRICS, you decided not to use the US dollar so much. For example, China and Arab nations, they are trading oil in the Chinese currency. So the prominence of US currency is going down. US economy also is supposed to go into trouble because of the huge debt issue that they have. For their interest expense is the third biggest line item on their P&L. So you can imagine majority of the money is just going in interest payments. It's not going in development. It is not going in asset creation, just pure, debt servicing. So that's why I believe that, debt is going to be a bigger issue. Of course, recession and debt, both of these things will, over the long term, reduce the economic superpower that US is. And China, for example, will become more and more prominent. Chinese currency will become more and more prominent. If you know, over the last couple of years, China has tried to sort of build positions across Sri Lanka, African nations, even in Arab nations, right? So they are working on, sort of becoming a superpower. India facing a border with China is also, crucial for us to keep spending more and more on our defense budget, right? So I think that's where the defense angle is very important. It's important for us to sort of make more and more defense equipment in India, and from that point of view, the Make in India Atmanirbhar project sort of plan of our honorable Prime Minister has been really helpful, and I think we will become more and more self sort of I should say we will build capabilities to make our own, defense equipment. So from that point of view, defense stays like a good long-term bet. But here in Prima Explosives, and this company specifically now is looking at a 10-year growth plan. They have raised 6,000, 8,000 crores, 8,060 crores to just sort of expand over the next 10 years. They are starting to export these defense equipment. Space research is becoming more and more important. Now, space kya is a regular thing, right? Because we keep firing, space. We keep firing, rockets to the space. So because of that, the demand from space industry for explosives is going to be a regular business for us. So for those reasons, I thought this was a good bet, but it was also kind of a momentum bet because defense was doing well, and the price to earnings ratio here is very, very high, right? So that's where we sort of slightly stuck. That's where I think I took a wrong call. Doing a completely momentum trade was slightly wrong on my behalf. And out of all the positions where we are not doing so well, this one is genuinely a mistake. And what we'll try to do is we'll try to reduce this position in the context of the overall portfolio in a way that, this underperformance will sort of not really affect our overall performance, which is what portfolio management is all about. So, it will happen that some of your trades will not work out, but it's also important that your capital allocation to those trades should not be very high. So in most of the cases and most of the portfolios that we build for our clients, Premier Explosive is the smallest position that we hold. So from that point of view, we are sort of slightly protected, and in the long run, we'll sort of rectify this mistake. But I sort of acknowledge the fact that doing a completely momentum trade without sort of really focusing on the price to earnings ratio was a mistake here. And we've now, like I said in the beginning, we've sort of migrated from doing momentum trades to now completely doing value trades, and hopefully we'll avoid such mistakes going forward. So with that, I will end this session. Thanks a lot for joining, and we can take any Q&A questions after this. Right. So thanks a lot, and hope you find this session helpful.